This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Thursday, August 6, 2026, and this is the New York session. Now, let's get into it. The US dollar is asserting dominance across the board, pushing through labor data beats while investors flee to safety as the Fear and Greed Index plunges to a mere 14 out of 100. We are looking at a market where the greenback is strong, gold is holding its ground against the tide, and central bank decisions are about to inject serious volatility into sterling. Let's get right into the data. On the schedule for today, Thursday, August 6, 2026, the market's eyes are locked on three key releases. First, U.S. initial jobless claims are set to release, following up on yesterday's ADP employment change and ISM Services PMI. Second, we have the crucial productivity and costs data, specifically the second look at unit labor costs. And third, wholesale trade figures will round out the domestic data pack. But the heavyweight for the Forex edition is the Bank of England's interest rate decision, which drops later today at 12:00 UTC. Apex, walk us through the strategic weight of that Bank of England decision against this macro backdrop.
It's not just a UK event, it's a global risk trigger. The Bank of England decision intersects directly with the higher for longer inflation narrative driven by that 199k jobless claims beat. If the Bank of England holds firm or signals hawkishness, it reinforces the dollar strength we're seeing. But if they pivot, it could destabilize the pound pairs that Grid has identified as fragile. It's the linchpin for whether we see a continuation of the dollar bull run or a flash crash in risk assets.
So the agenda is set. Let's look at the broader tape as of 9:32 ET. The Fear and Greed Index is screaming fear at 14/100, yet the VIX is sitting relatively tame at 16.5. That dissonance is worth noting. Across the majors, the dollar is broadly higher. Aussie dollar is down 0.15% to 0.70468. Euro dollar is off 0.7% at 1.1549. And dollar yen is up 0.7% to 157.723. Gold is down slightly at 4,263.59, but holding steady against the stronger dollar. SPECTER, that VIX reading bothers me, is the market underpricing the stress?
It absolutely is. You have a fear and greed score of 14/100, which implies extreme caution, but the VIX is at 16.5, which is historically low. This is a slow bleed scenario. Investors are pulling back from risk, favoring safe havens like dollar and gold, but they aren't paying for protection via options. The yield curve is flat. The 10-year 2-year spread is just plus 0.45 pp, with the 2-year at 4.2% and the 10-year at 4.63%. That flat curve is a classic precursor to stress. We have a disconnect between sentiment data and actual volatility premiums. It's a quiet accumulation of tail risk.
So we have a complacent market facing a potentially volatile day. Pulse, help us understand why the dollar is getting this love right now. What's driving the bid in dollar yen and the sell-off in euro dollar? It's the data dependency meeting stubborn inflation. We saw initial jobless claims come in at 199k, beating the 202k estimate. That signals a resilient labor market. But look at the inflation side. Q2 prelim unit labor costs came in at plus 1.3% versus plus 2.1% expected. While that missed expectations, the absolute rise reinforces sticky wage inflation dynamics. With CPI at 3.46% and core PCE at 3.29%, both well above the Fed's 2% target, the Federal Reserve is anchored in a higher-for-longer stance. There is no room for dovish pivots right now. That structural rigidity in monetary policy is what's bidding up the DXY, which is sitting at 119.7. The market isn't pricing in a rate cut. It's pricing in prolonged restraint. Let's dig into the headlines shaping this flow. We have a cluster of stories. First, U.S. initial jobless claims 199K versus 202K estimate. Pulse, you touched on this, but how does this specific print shift the currency landscape immediately? It validates the dollar bid. When claims come in better than expected, it removes the immediate narrative that the labor market is cracking. It gives the Fed cover to hold rates steady or hike if necessary. This directly impacts the euro dollar and cable, both rate-sensitive currencies. They are getting crushed because the market realizes the U.S. economy is running hotter than anticipated. It's a direct drag on the euro and pound, unless the ECB or Bank of England matches that toughness. Second headline, the dollar is mostly higher vs the major currencies to start the NA session. Grid, from a pure price action standpoint, what does this dominance look like on the charts right now?
It looks like consolidation at extremes. Look at dollar yen, it's at 157.723, sitting right under the 5-day high of 157.96. It's trying to push through, but it's hitting resistance. Meanwhile, euro dollar is at 1.1549, hovering just below its 5-day high of 1.15596. It's range-bound, but the most critical spot is dollar CAD. We are at 1.40132, which is practically touching the 5-day low support at 1.40026. This is a binary technical state. If that 1.40026 level breaks, we see a cascade. If it holds, we stay in this compressed range. The strength is real, but it's testing the boundaries of liquidity.
Third headline, silver trims some gains on delayed US-Iran deal as traders await the USCPI. And we have a note on dollar CAD tests key target support levels. CIPHER, let's look under the hood. Why is dollar CAD so sensitive at 1.40132? What are the institutions doing?
It's a positioning trap. On the CFTC commitments of traders' data, leveraged funds are extremely bearish on the Canadian dollar. We're talking a net short position of 102,495 contracts. Asset managers are also net short 101,160. You have a dense wall of shorts stacked just below that 1.40026 support level. The market is priced for further weakness in Canadian dollar. But when you have that much short interest in one spot, any break below 1.40026 doesn't just result in new sells, it triggers a mechanical cover cycle. Shorts have to buy back to cover, which amplifies the upward velocity of dollar CAD. It's a squeeze waiting to happen.
Let's dive deep into the biggest movers. First up, dollar yen. It's at 157.723, up 0.7%. It's nearing its 5-day high of 157.96. Grid, give us the technical map.
The pair is consolidating below 157.96. The 5-day low support is at 155.229. Currently, price action is neutral or bullish, but it's hitting a wall at 157.96. That's the immediate resistance. If we get a close-up of that, the path clears. But right now, it's choppy. The momentum has stalled near that psychological resistance. It's not a clean breakout yet.
And that's where the danger lies. Leveraged funds have surged their yen longs by plus 103,259 contracts week over week. That is a massive crowding event. You have billions of dollars betting against the yen. When everyone is long, the move becomes fragile. If the 157.96 resistance holds and starts to reject, those crowded longs become the fuel for a sharp correction. It's a liquidity trap.
Exactly. And remember the yield curve. The 10-year 2-year spread is flat at plus 0.45 pp. Carry trades thrive on steep curves. When the curve flattens, the incentive to hold long yen positions diminishes. Combine that with CIPHER data on the crowded longs, and you have a perfect storm for a mean reversion trade. The VIX might be low, but the structural risk in the carry trade is high.
So we have technical resistance at 157.96, crowded longs, and a flat yield curve. Pulse, is there any room left for the dollar to strengthen against the yen, or is the damage done? There's always room if the data holds. The 199K jobless claims beat suggests the U.S. economy isn't slowing down enough to force a Fed pivot. As long as the 3.46% CPI data remains a concern, the dollar has structural support. The issue isn't whether the dollar can go higher. It's whether the current price is sufficient to unwind those crowded yen longs. Until the Fed gives explicit guidance, the bias remains higher, but the crowding increases the volatility risk. Moving to cable, it's at 1.34607, down 0.6%. The Bank of England decision is looming. Grid, what's the setup?
Price is at 1.34607, which is sitting squarely in the lower quartile of the 5-day range. The 5-day low is 1.34176 and the high is 1.35065. We are seeing prevent compression. The daily range has been tight, high 1.34726, low 1.34581. Technically 1.34176 is the critical floor. If that breaks, we open the door to further downside, but right now it's just holding within the range. I'm challenging Pulse assumption of immediate volatility. The chart hasn't broken yet. It's waiting for the news to validate a direction.
But look at the positioning. Leveraged funds have dropped their pound net longs by 40,644 contracts week over week. That's a rapid de-risking. Even though they are still net long plus 453, the sharp drop shows institutions are reducing exposure ahead of the vote. They aren't betting big on a pound surge. They're hedging. That reduction in long exposure means there's less support behind the 1.34607 level if the news comes out dovish.
So we have technical compression and weakening institutional support. Apex, how do we view this relative to the US data?
We view it as an asymmetric risk. The US data, 199K claims, is strong. The Bank of England decision is a binary event. If the Bank of England holds rates, pound could weaken further towards 1.34176. If they cut or hint at easing, pound could wobble harder. But given the dollar strength from the US labor data, the base case is pound weakness. However, the crowding in yen longs and the dollar strength create a cross-current. You don't want to be short pound blindly if the dollar strength drives a global risk-off cascade. It's a tricky environment.
Let's talk about dollar CAD. It's at 1.40132, up 0.2%. Grid, you mentioned this was a critical floor.
It is. Price is 1.40132, which is just 0.00106 pips away from the 5-day low support at 1.40026. This is the session's primary technical hinge. A close below 1.40026 invalidates the current support structure. If we lose that, the path opens to the previous week's lows. If it holds, we stay range-bound. It's a binary technical state right now.
And that support is backed by a mountain of shorts. 102,495 net contracts from leveraged funds. If 1.40026 breaks, it's not just a technical break, it's a margin call. Those shorts have to cover. That mechanical buying pressure will accelerate the move higher. It's a squeeze risk that overrides fundamental valuation for a moment.
And consider the broader risk. The fear and greed index is 14/100. When risk appetite dies, commodity currencies like the Canadian dollar suffer. But if the US labor data is too strong, it might spark recession fears given the flat yield curve. If that happens, the Canadian dollar might actually find a bid as a proxy for US growth concerns. It's a double-edged sword. But for now, the short positioning makes 1.40026 a powder keg.
Finally, let's touch on gold. Gold is at 4,263.59, down 0.34%. It's holding relatively well despite the strong dollar. SPECTER, why is gold resisting the dollar strength?
Because the VIX is lying to you. The VIX is at 16.5, but the fear and greed index is 14/100. Smart money knows the calm is artificial. They are buying gold as a hedge against the coming volatility. Gold is at 4,263.59, holding near today's low of 4,260.45, while the 5-day high was 4,304.21. It's pulling back, but it's not collapsing. This is safe haven demand kicking in. The dollar is strong, yes, but investors are worried about the 3.46% CPI and the 3.29% core PCE staying high. They aren't trusting the Fed to fix it quickly, so they keep gold as a ballast.
Agreed. The 3.46% CPI is the anchor. Until that gets closer to 2%, gold retains its appeal as an inflation hedge, even if nominal yields are high. The real yield environment is supportive of precious metals. So we have gold holding up as a hedge against sticky inflation and hidden volatility. Apex, tie this all together. What is the overarching picture for the Forex edition today?
The convergence is clear. Resilient US labor metrics, 199K claims and sticky inflation, 3.46% CPI, have cemented a structural bid for the dollar. This is visible in the trade-weighted index at 119.7. This creates an asymmetric risk profile. We have a crowded yen-long trade that is vulnerable to a rejection at 157.96 grid and a Canadian dollar short position that threatens a squeeze if 1.40026 breaks, CIPHER/SPECTER. Meanwhile, pound is caught in the middle, with weakening institutional support CIPHER and technical compression grid, awaiting the Bank of England decision pulse. The strategy is to respect the dollar strength, manage the risks of the crowded yen trade, and watch the Canadian dollar support level as the primary trigger for volatility. The Bank of England decision is the wild card, but the macro wind is firmly at the dollar's back.
To recap the key takeaways for the Forex edition. First, the US dollar is structurally supported by strong labor data and sticky inflation, creating a hostile environment for rate-sensitive currencies like pound and Canadian dollar. Second, watch the technical hinges. Dollar-yen facing resistance at 157.96 with crowded longs, and dollar-CAD teetering on the edge of 1.40026, where a break could trigger a violent squeeze. Third, gold is holding steady at 4,263.59 as investors hedge against the disconnect between low VIX readings and high fear and greed stress. Tomorrow, we'll be watching the aftermath of the Bank of England decision and the next wave of US data. Stay tuned, stay sharp. This is ShadowQuant Forex edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.